Hello friends. Here is summary of Chapter 21 from Technical Analysis of the Financial Markets by John J. Morphy. This chapter covers one of the most widely used tools in technical analysis, Fibonacci numbers and the golden ratio. Chapter 21, Fibonacci numbers and the golden ratio. Welcome to Chapter 21 of Technical Analysis of the Financial Markets. In this lesson, we dive into the world of Fibonacci numbers, ratios, and how they help traders predict price movements, retracements, and targets. Let's explore the magic behind the math. Introduction to Fibonacci numbers. The Fibonacci sequence is a series of numbers where each number equals the sum of the previous two. 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, and so on. This sequence is seen in nature, human behavior, architecture, and financial markets. Morphy explains that these numbers lead to ratios that help identify key turning points in price charts. The golden ratio. The most important Fibonacci ratio is the golden ratio, 0.618. It comes from dividing one Fibonacci number by the next one. For example, 34 divided by 55, 0.618. Its inverse is 1.618, another critical level. These ratios repeatedly appear in market movements. Fibonacci retracements. When a market trends upward or downward, it rarely moves in a straight line. Instead, it pulls back in predictable proportions. The most commonly used retracement levels are 38.2%. 50%, not Fibonacci, but psychologically important. 61.8%. Traders plot these levels to find support and resistance zones during corrections. Example. If a stock rises from 100 rupee to 200 rupees, a typical correction might fall to 161.8 level for targets. 61.8% retracement 138 rupees. 50% retracement 150 rupees. 38.2% retracement 162 rupees. These levels act like magnets for price reversals. Fibonacci extensions. Extensions are used to project future price targets beyond previous highs or lows. Common Fibonacci extension ratios. 61.8%. 100%. 161.8%. 261.8%. Example. Wave 3 in Elliott wave often extends to 161.8% of wave 1. Wave 5 may reach the 100% extension of wave 1. Fibonacci clusters. A powerful concept introduced in this chapter is Fibonacci clustering. This happens when multiple retracement or extension levels from different swings align at the same price area. Clusters create high probability reversal zones. When several Fibonacci levels match, the area becomes a strong support or resistance. Time analysis with Fibonacci. Fibonacci isn't just for price, it also applies to time analysis. Fibonacci numbers like 5, 8, 13, 21, 34, 55, etc. can be used to estimate when turning points may occur. Morphy notes. These time projections are less reliable than price-based Fibonacci tools. But they still help identify potential cycle lengths and reversal periods. Fibonacci arcs, fans, and time zones. Morphy describes additional Fibonacci tools. 1 keycap Fibonacci arcs. Curved support resistance zones based on retracement radii. 2 keycap Fibonacci fan lines. Diagonal trend lines projected using retracement ratios. 3 keycap Fibonacci time zones. Vertical lines on the chart marking time-based Fibonacci intervals. These tools give traders visual structure to understand price geometry. Combining Fibonacci with other tools. Fibonacci is most effective when combined with trend lines, moving averages, Elliott wave, candlestick signals, support and resistance, volume patterns. A Fibonacci level becomes more powerful when multiple signals confirm it. Chapter 21 teaches us that Fibonacci ratios are not magic. They are reflections of natural human behavior, which shows up again and again in market patterns. Fibonacci helps traders identify potential reversals, project future targets, and understand market geometry. When a market respects Fibonacci levels, it gives traders a clear roadmap of where price may turn next. Thank you friends for listening this audiobook. Please like, subscribe and share this channel.